Singh, the currency analyst for Nirmal Bank. So let's look at what has happened in the Forex market. So last 2 weeks was quite eventful for the Forex because we have seen a lot of central bank coming out and holding their policy meet, as well as the UK's new government has come out with its budget. Now, starting with Bank of Japan, so in its policy meet, they have continued with the interest rate at negative 0.1%. But of course, we have seen quite a big intervention into the forex market by the government there. So they have done the intervention of around 3.6 trillion Japanese yen, which comes around 26.9 dollars. So the quantum of the intervention was quite huge as compared to this kind of intervention we had last seen in 1998. So the quantum, if you compare, it was almost a trillion Japanese yen more. So in 1998 we had seen the intervention of 2.6 trillion Japanese yen. So of course this was done by the government and the finance ministry, as said before. Bank of Japan Governor Kudo has come out and supported this move by the government. He has said that the central bank supports this action, and of course it was done keeping in light the current high volatile session that the Japanese yen has seen. So the one point that we must consider, or take it as a point from it, would be that the intervention was not done in order to get the rupee appreciated in front of the dollar, but it was taken as a step to curb the high volatile session that it had seen. Thus, if you look at the momentum in the Japanese yen, it has again resumed the depreciation towards 144 to 145 levels. And I think keeping in mind that Bank of Japan as well as the government there has continued with its stand on the accommodative, keeping the policy accommodative, supporting the economy through various packages and so forth, or through buying of the bonds, Japanese yen could again slid to 145 and beyond in the coming days. Now moving on to the ECB, ECB did a rate hike of 0.75%. Now, if you look at the current statement from the ECB, the governor there, Christine Lagarde, had said that they will consider the contraction into their balance sheet once they have brought the interest rate to the normalization frame. Now, of course, what they are considering is that right now the best move for the ECB to get the inflation under control into the whole eurozone will be to get through the interest rate hike tools. Of course, if you look at the quantum of the liquidity that they had infused into the whole eurozone economy, comes around 5 trillion euros. Now, to get that quantum sucked out, and the time frame that it will require to do so without aggressively hurting the economies there, will be a very difficult feat that the ECB has to achieve in the coming days. So in the next policy meet, we are again expecting it that they'll continue with the rate hike of 0.75% and could bring the interest rate to around 2%. For the pound, we were expecting a more aggressive interest rate hike of around 0.75 bips by the Bank of England, taking into consideration that their inflation is at an all-time high, but they only came out with a 50 bips rate hike. So this crushed the pound, taking a dip against the dollar. Now further it slid once the new government, the Truss's government, came out with the budget. There they have introduced heavy tax relief packages, plus they have also came out with the energy bills in order to cap the expenditure on the energy and give some relief to the cost of living there. but it does indicate a heavy borrowing from the government side, and it could very deeply affect the current account deficit there. And take into consideration that uh, they have brought down their tax rates quite from 20, for example, for the corporate, they have cut down the tax from 25 to 19%. So they have also limited their income. So the whole scenario for the UK economy does look quite grim, because their current budget is betting on the assumption that the economy will do good, and if it does not do good, there will be a problem of servicing this high borrowings, this high government debt in the coming future. Thus, if you see, pound has slid almost 5%. It is still trading at 1.06. If the situation worsens and the government is not able to service its high debt, it could even come to parity and below that. So very negative outlook we have on the pound. For the Fed, the FOMC has, and even the Fed governor has come out and said that whatever the policy stand that they have taken right now, which is hawkish and aggressive with the interest rate hike, it will hurt the businesses and the labor market. The labor market right now sits at around 3.7%, and they are forecasting it to fall to 4%, the unemployment rate. So definitely they have acknowledged it, but in order to get the inflation under control, they have time and time again said that an aggressive stand needs to be taken. So right now the prioritizing the bringing down the cost. Thus, expect the dollar index to trade on the higher highs, to continue with its strong bullish momentum, and it will again test 115 levels and beyond. Take into consideration the perspective that we have on the euro and pound, which is quite grim. Now, for the Indian rupee has tested its all time low at 81.62. This was an all-time low for the Indian rupee. Now, one of the reason why was, of course, the strong bullish momentum into the dollar index have impacted the Indian rupee in the current scenario, and also the weak domestic equities and the FII inflows have impacted. Now, why the RBI has not come out and intervened like it did so before, defending the 25 levels, is because there is a liquidity crunch into the banking system right now, and this is one of the reason why we are not seeing RBI coming aggressively into the forex market and intervening and getting the depreciation under control. And with all the perspective put into the picture, I think USD INR will continue with its depreciating stand, and we could even see levels of 82, 82.25 in the coming sessions. So that's all on the currency front. Thank you.